SCHD, the dividend fund everyone wrote off as dead money, is crushing the S&P 500 in 2026. The fund is up 14.73% year-to-date while the S&P 500 limps at barely 1%, and the shift happening beneath the surface could reshape how millions of investors build wealth for the next decade. For 3 straight years, from 2023 to 2025, this fund got destroyed by tech-heavy QQQ, lagging so badly that investors questioned if dividend investing was dead. But something fundamental just changed, and SCHD's performance isn't random. It's a signal that could determine who makes money and who gets crushed over the next few years. Tech stocks that minted fortunes for 5 years are suddenly bleeding. Microsoft dropped from $565 to $400. Nvidia entered a bear market, down 20% from November highs. Software companies like Atlassian and Salesforce, down 60% from their peaks. But while tech investors panic, SCHD quietly demolishes the market. Is this the rotation where overvalued tech gives way to cash-generating dividend stocks? Because if it is, the implications are massive. Right now, 3 forces that haven't aligned in over a decade are converging. The Fed is signaling rate cuts in 2026, with the federal funds rate projected to drop from 3.75% to 3% by year-end. When rates fall, dividend income crushes bonds and savings accounts. Second, tech valuations are stretched. QQQ trades at a PE of 34.6, which is 30% more expensive than the broader market. SCHD sits at just 17, almost half the Nasdaq's valuation. Third, geopolitical chaos and tariff wars push investors toward defensive sectors: energy, healthcare, consumer staples, exactly where SCHD is heavily weighted. But there's a hidden pattern in SCHD's performance that Wall Street doesn't want you to see. If we pull up SCHD's performance over the past 5 years, we see a pattern that most investors completely miss because they're too focused on short-term returns. Let's start with 2022, the year everything crashed. The S&P 500 dropped 18%, QQQ collapsed 33%, and everyone was panicking. But look at SCHD during that same period. It only fell 3.26%. While tech investors were getting annihilated, SCHD holders barely flinched. Then 2023 and 2024 hit, and tech came roaring back. AI hype took over. The Magnificent 7 stocks went parabolic. And suddenly, SCHD looked like a terrible investment. Up only 4.55% in 2023 while QQQ soared. In 2024, the gap widened even more, with SCHD returning 11.66% versus QQQ's 75%. This is where most investors make their fatal mistake. They look at those 2 years and conclude that SCHD is trash, dividend investing is dead, and that you should just go all in on tech. But that's exactly what the market wants you to think right before it punishes you. We're seeing an almost exact replay of 2022's market dynamics, except the rotation is even more violent. Back in 2022, inflation spiked, rates rose, and investors suddenly cared about cash flow and profitability. Tech stocks that printed money for years started bleeding. Nobody wanted to pay 50x earnings for companies that might turn profitable in 5 years. 2026 is the same shift, different reason. This time it's concentration risk and fear that AI valuations have gotten ahead of reality. The S&P 500 now has its highest concentration in top 10 holdings in history. Over 38% is just 10 companies, most of them big tech. And investors are finally asking, what happens if this doesn't work out? That question is driving billions out of megacap tech and into funds like SCHD. But SCHD's comeback isn't just about market rotation. It's also about what happened under the hood in March 2025. See, every March, SCHD goes through what's called a reconstitution, where it kicks out underperforming companies and adds new ones based on strict criteria. 10 consecutive years of dividend payments, strong free cash flow, low debt, and solid fundamentals. In March 2025, SCHD made its most dramatic changes in years. It booted out 17 stocks, including big names like Pfizer and BlackRock, and added 20 new ones. But more importantly, it completely reshuffled its sector exposure. Energy went from 12% of the portfolio to over 20%, with ConocoPhillips becoming the fund's largest holding. Healthcare got a major refresh, swapping out Pfizer for Merck. And financials got slashed from 17% down to 8.5%, cutting exposure to struggling regional banks. Now, Some investors criticize this move. Why are you going so heavy into energy when oil prices are weak? But here's what those critics missed. SCHD wasn't betting on higher oil prices. It was betting on undervalued assets with massive free cash flow trading at discounts. And so far in 2026, that bet is paying off spectacularly. But not because oil prices surged or because energy suddenly became the hottest sector. It's working because of something much more fundamental that's creating the perfect storm for dividend stocks. The valuation gap between SCHD and the broader market just hit levels we haven't seen in over a decade. SCHD trades at a PE of 17. The S&P 500? 22. Nasdaq 100? 30. You're paying almost half as much per dollar of earnings with SCHD for quality companies like Chevron, Merck, AbbVie, and Coca-Cola with decades of consistent profits. And when investors question paying 150x earnings for Palantir or Tesla, that reliability becomes incredibly valuable. 2. The dividend yield advantage. SCHD yields 3.8% versus 1.3% for the S&P 500 and under 0.7% for QQQ. You're getting higher yield than the 3.5% Treasury bill, plus equity upside. And those dividends have grown 5.6% annually over 5 years. When the Fed cuts rates in 2026, with projections showing drops from 3.75% to 4% to 3% by year-end, that yield advantage becomes a magnet for capital flowing out of money market funds. And 3. The AI bubble hedge. The biggest force? Fear. Fear that AI spending won't pay off. Fear that tech valuations are too high. Fear that the next DeepSeek moment craters megacap tech overnight. SCHD has zero exposure to that risk. No Nvidia, no Meta, no Microsoft. Instead, companies that keep paying dividends whether AI succeeds or fails. The ultimate hedge without betting directly against it. But before you dump some more money into SCHD, understand the real risks. Energy exposure. Over 20% in energy stocks is a massive bet on a volatile sector. If oil collapses or renewables accelerate faster than expected, that 20% could drag down returns significantly. Slow growth. These are mature businesses. Analysts show sales and earnings growth declining. High payout ratios mean companies are returning cash because they don't have better uses for it. SCHD won't 10x your money. It's designed for income and capital preservation during downturns. Backward-looking methodology. The rules-based system requires 10 years of dividend history. This is the trade-off. QQQ offers the highest ceiling but the most brutal floor. SCHD offers strong, consistent outcomes. VTI sits in the middle. So this brings us to the critical question that every investor needs to answer for themselves. What kind of ride can you actually stay on? See, everyone wants the highest returns possible. That's human nature. But the reality is, the highest returns usually come with the most violent volatility, and most investors panic sell at exactly the wrong time. A colleague of mine learned this the hard way. Back in 2022, he was all in on QQQ, convinced that tech was the future. When the Nasdaq crashed 33%, he held on barely. But by the end of 2022, seeing his portfolio down 6 figures, he sold everything and moved to cash. Then in 2023, tech rallied 75%, and he missed the entire recovery. That's the problem with chasing the highest returning assets. If you can't stomach the drawdowns, you'll never capture the gains. So I wanted to quantify this exact trade-off, not with theory or opinions, but with actual data. So I ran a Monte Carlo simulation, thousands of market scenarios over 30 years, comparing $10,000 invested in SCHD, VTI, and QQQ. Worst case scenario, SCHD ended with $1.45 million. VTI, just $475,000. QQQ, a shocking $139,000. In bad markets, SCHD holders would have 3 times more than VTI and 10 times more than QQQ. Median scenario, SCHD grew to $3.05 million, VTI hit $1.83 million, QQQ reached $1.15 million. Best case scenario, QQQ exploded to $7.92 million, beating SCHD's $6.3 million and VTI's $5.94 million. The message is clear. QQQ has the highest ceiling but the most brutal floor. SCHD offers the strongest, most consistent outcomes. And most investors can't stomach QQQ's downside to capture its upside. So, what this means for your portfolio? Don't go all in on SCHD just because it's hot. That's the mistake tech investors made in 2024. Use SCHD as a defensive, income-generating core that reduces volatility while participating in gains. And here are 3 strategies that work. Strategy number 1. SCHD's 3.8% yield generates real income. $500,000 position equals $19,000 yearly in dividends that grow 5 to 6% annually, keeping pace with inflation. Reinvest during accumulation years. Take distributions when needed. Strategy number 2. Allocate 20 to 30% to SCHD to dramatically reduce downside risk. In 2022, QQQ fell 33%. A portfolio that was 70% QQQ and 30% SCHD would have only fallen 24%. Painful, but survivable. Strategy number 3. Fixed allocations between QQQ, VTI, and SCHD with annual rebalancing. When growth outperforms like 2024, sell QQQ and buy SCHD. When value outperforms like 2026, reverse it. This forces buy low, sell high, automatically. That said, remember to not invest more than how much you can afford to lose. This is Andrew. I hope this video was helpful. If yes, consider subscribing to the channel. And I'll see you in the next one.